What's going on, guys? My name is Grant Warfield and I'm a CPA candidate. Today I'm going to walk you through retained earnings. Let's get into it. Alrighty, gang, let us waste no time. As I typically do, I start with the common misconception, dispel the myth, and then give you some formal structure as it relates to this accounting topic. So to kick us off here, a common misconception around retained earnings is that it is synonymous to cash, and that is simply not the case. Retained earnings is not a bank account. It isn't a pile of money, nor is it cash sitting somewhere. In order to fully understand exactly where retained earnings lives, we're going to have to travel to the infamous accounting equation. And I created a video yesterday about the accounting equation, so if you're interested, definitely check that out. It'll give you more context on what I'm speaking about today. So what is this accounting equation? Well, it's simple. It's going to be assets equals liabilities plus equity. Okay, and this is not a formula, it's an identity, meaning this relationship must always ring true. If a company is properly maintaining its accounting records, at any point in time, assets are going to equal liabilities plus equity. Okay, so that's just something you have to be aware of. But I want to double click on equity here because there are two main components of equity that I wanted to make you aware of. The first portion is what's called contributed capital, and this is when the owners of the business invest their own resources into the entity or into the company. The second portion is what we're talking about today, and it's called retained earnings. This is a function of net income, and as you might be able to infer from the name of this account, it is based upon what has been earned historically, okay? So there's earned capital and there's contributed capital. Today we're focusing solely on what's considered earned capital. Now you guys know me, I'm big on formal structure. I'm big on definitions because they eliminate ambiguity. So I'm just going to give you a brief definition of exactly what retained earnings is from a financial reporting perspective. It goes as follows. Retained earnings is going to equal net income minus dividends. It's that simple. And so net income, as you may or may not know, is from the income statement. So we take revenue, okay, minus expense, and that's going to equal net income. Super simple. Now, a dividend is considered a distribution of earnings to shareholders. Okay, and let me draw this out for you or map it out for you. So we make our revenue, right? Customers pay us. We pay our expenses. That leaves us with net income, okay? Net income is considered earnings. Now at this point, we have one of two choices. We can either retain these earnings, okay, i.e. retained earnings, which is what we're talking about today, or we can distribute those earnings, which is what will be considered dividends. The choice is entirely up to the business based on its current financial standing and future outlook, but the main point that I want to communicate here is that in order to derive retained earnings, you're simply going to subtract dividends from net income, okay? So retained earnings is going to be accumulated profit, okay? And let's underline that word accumulated because it is doing a lot of work here. When I say accumulated, I simply mean that this account balance represents all of the profit that has not been distributed since inception, all of the profit that has been retained, if you will. Now let's go over a simple example to really make my point clear. So we have net income in year one of $1 million, and we pay out dividends to owners of $200,000. So we could do quick math here and come to the conclusion that retained earnings has increased by $800,000. Now let me throw you a curveball. Does that mean cash has increased by $800,000? Not necessarily, and allow me to explain why. So let's take a look at this simple balance sheet here. We have our assets, our liabilities, and our equity, okay? And just to formalize this, let's draw our beloved equation. Now, we know if you happen to watch my previous video, or I'll just go ahead and tell you now, that one side of this equation cannot move without affecting the other side of the equation in the same direction, okay? That's just accounting physics, we could say. So an increase in net income is going to represent an increase in equity, okay? So let's go ahead and draw this out. Equity is going to increase here. And if liabilities remains constant, then we know that assets is going to increase in this scenario. Now, if we look over here to our example balance sheet, if we look at the asset section, we see that assets consist of cash, inventory, and equipment. In this example, retained earnings has increased by $800,000. But let's say that the company wants to use these resources to reinvest in equipment. Now, for the sake of this example, we're going to assume that these customers are paying in cash. But you must recall that in a real-world scenario, we could recognize revenue when we earn it, not necessarily when we receive cash. If we have earned revenue and a customer hasn't paid us up front, we are going to record something called accounts receivable, meaning we're due to receive that cash at some later date. So initially, cash is going to go up by $800,000, but they're going to use this cash to purchase equipment. So it's going to go right back down, and equipment is going to go up by $800K. And if we travel down to our equity section, we can see that retained earnings is also going to be increased by $800,000. So with this example, I just wanted to show you that retained earnings represents accumulated profits that have not been distributed to owners over time. But these profits are not necessarily sitting in cash. They may exist as receivables, inventory, equipment. They could even be used to reduce liabilities. So the main point that I want to communicate here is the fact that cash and retained earnings are different categories. Okay, retained earnings is going to represent an ownership claim, and cash is going to be considered an asset. Those are two different sides of the accounting equation. And confusion occurs because people tend to conflate profit and cash, equity and cash. That's simply not the case. Those are two different sides of our beloved equation. That's all, folks. Thank you so much for watching. I really appreciate your time. Please let me know what you think in the comments. Like, subscribe, stay tuned. Thanks.